Mm-hmm.
Tech continues to show leadership. We were talking about it last week. NVIDIA alone, almost a third of the S&P's gains so far this year. And at the same time, we're still seeing that the rally broaden out. Small caps at a 52-week high. We've seen other areas hit other 52-week highs. What's stopping this rally? Is there anything in your mind in the near term that could stop it?
Jay Powell could stop it this week when he testifies, as well as at the March meeting later this month. That being said, we continue to be very bullish on tech. I think you can throw those .com bubble analogies out the window. It's not the same period. Earnings are the market's actually in fair value range, even assuming no estimate increases from where we are right now. So we think that tech continues to be strong. Now, that being said, you still have to be picky on where in tech you go. Obviously, you have the AI infrastructure play we've talked about on your show. Crypto is, our big theme for 2024, and other, disruptive companies within the tech space that should continue to do well. But you do have to be mindful of the Fed. You do have to be mindful of the timing of the rate cut. So the way that we're approaching it is we're operating in smaller windows of time between each economic milestone, where we take on and take off risk. We have this period after PCE where we can take off risk up until the March meeting with the Fed. And that's the way you got to play it, adapt and contract when necessary.
So, Bill, I'm going to come over to you. Over the weekend, Vital Knowledge, Adam Christofilinos, guys, with a great note, echoing the sentiment of what we heard from many on Wall Street, that the market is simply priced to perfection. His concern in the note, at least, if we get some bad news, that could lead to a pullback. In the near term, James just cited Jay Powell, but in the near term, is there anything that you think could be, quote unquote, bad news that could hit this rally?
The worst thing that can happen to the rally is that it freaks itself out because of fear of rising interest rates. And I think one of the things that all the market would agree on is that this rally is fueled by artificial intelligence being implemented in technology that is real and profits are real. And one of the things that I think the market's going to realize is that even though the boogeyman of Jay Powell raising rates is something that could kill the rally, the reason for Powell raising rates is almost non-existent now. There's no recession. There is no high inflation in sight. Inflation is on its way down, and Chair Powell has reassured us of that. One of the things that we should watch out for is the timing and size of the rate cuts. And I think one of the things the market has underestimated is that the interest rates may level off at a much higher level because productivity from AI technologies will be much higher in the future. And that's something that the market has to realize, that high interest rates will not cut off the rally, but reflects the higher productivity from the rally.
While you're talking about productivity, you actually sent us a chart. It actually came from the Fed, but it compares the PC revolution, which does have some overlap with the .com bubble, and the AI boom that we're seeing today, and what that means for productivity. So I want to get a sense. We're showing the audience the two points that you want us to see. The PC revolution is on the left. The boost from AI is on the right for people that are listening. In your mind, what's the most important part of this comparison?
I think we should realize that what the PC revolution did was to boost profits, almost doubling them during the 1990s. But it was a transitory boost that lasted a decade. What we see now in the post-COVID recovery is that profits have really shot up because the higher technology and better technology has allowed businesses to reorganize themselves in a much more efficient way. And if AI actually kicks in and boosts this even further, I think what we'll see is a win-win situation where not only will corporate profits per unit of output be higher going forward, but also real wages will be higher because labor productivity is also higher. So if these are the bright future things that we can see in the next year or 3 years horizon. But the thing that would kill it would be any kind of geopolitical risk that causes inflation to really skyrocket, which will cause the Fed to stop its rate cuts and be able to fuel the ongoing recovery.
James, I'm coming back to you. So Bill mentioned something that a lot of people mention when it comes to risk in the markets, geopolitical risk. However, we have seen two wars going on. We still see markets hit new highs. And then also, we appear to be on track for a ceasefire, at least when it comes to Israel and Gaza. It seems like we may be on that way. Isn't that just more fuel for the rally to continue, some of the factors that we're seeing basically calming down?
Yes. I mean, in short, yes. I mean, anytime you remove geopolitical risk off the table, that's going to help longer duration assets. And a lot of these tech themes that we're seeing play out right now are longer duration. So that is certainly a good thing. I think that inevitably, when you think about the broader economy and rates, the rates are going to come down. The only question is when. I think that, is it going to be summer or the fall? I think that's the calculus. But ultimately, these trends that we're seeing will push forward. As long as you can manage that risk between now and then, you should end the year higher than where we are right now. So we continue to stay bullish. You got to stay vigilant on the economic data. But at the end of the day, when you look at it on a full year basis, you're going to be better off at the end of the year than you are today.